This is financial entropy, and today we're investigating the systemic decay of America's most trusted financial institutions, the savings and loan associations, that for generations represented the safest place an American family could put their money. Picture a Saturday morning in 1979. A father and daughter walk into their neighborhood savings and loan in suburban Dallas. The lobby smells faintly of coffee and carpet cleaner. The teller knows them by name. They're depositing the daughter's birthday checks into her college fund, $15 that will earn 5.25% interest, guaranteed, insured by the federal government. This is the financial bedrock of middle-class America. Within a decade, that same building would be emptied, seized by federal regulators, its assets scattered, and that father's life savings reduced to a fraction of their value. Not because of a bank robbery, not because of a stock market crash, but because of something far more insidious. A slow motion collapse that would ultimately cost American taxpayers $132 billion. The savings and loan crisis of the 1980s wasn't just a financial disaster. It was a masterclass in systemic entropy, the gradual transformation of order into chaos, of safety into risk, of community institutions into gambling operations. And unlike most financial crises, this one was foreseeable, preventable, and in many ways deliberately engineered. The mystery at the heart of the story is deceptively simple. How did the safest, most boring sector of American finance transform into a carnival of fraud, speculation, and institutional collapse? The answer reveals something fundamental about financial systems, that stability itself can become a vulnerability, and that the guardrails designed to protect us can become the very mechanisms of our destruction. Part 2. The architecture of stability. To understand how the system failed, we must first understand how perfectly it once worked. The savings and loan industry was born out of the ashes of the Great Depression. Before 1929, families saved money in commercial banks that used those deposits to make short-term business loans. When the Depression hit and banks failed by the thousands, Americans learned a brutal lesson. Your savings were only as safe as your bank's riskiest loan. The S&L model was designed to be different, radically, almost boringly different. The S&L Home Loan Bank Act of 1932 created a parallel banking system with one simple purpose: to help Americans buy homes. S&Ls would take deposits from savers, pay them a modest but guaranteed interest rate, and lend that money out as 30-year mortgages at a slightly higher rate. The difference, the spread, was their profit. This was banking reduced to its most elemental form. An S&L president in 1960 could summarize the entire business model in what became an industry joke: the 3-6-3 rule. Pay 3% on deposits, charge 6% on mortgages, and be on the golf course by 3 o'clock. The system was intentionally constrained. Federal regulations limited what S&Ls could do with depositor money. They could make home loans. That was essentially it. No commercial lending, no corporate bonds, no stock market speculation. The geographic area they could lend in was restricted. Even the interest rates they could offer were capped by something called Regulation Q, which prevented S&Ls from competing too aggressively for deposits. These weren't bugs in the system, they were features. The entire architecture was designed to be stable, predictable, and boring. The S&L system was deliberately structured to minimize risk through operational simplicity and regulatory constraint. And for nearly 40 decades, it worked beautifully. S&Ls financed the great American suburban expansion. The rows of identical homes sprouting across the landscape after World War II, each one was likely financed by a local S&L. By 1980, there were nearly 4,000 savings and loan associations holding more than $600 billion in assets. They were as much a part of the American landscape as fire stations and public libraries. But the very stability of the system contained the seeds of its destruction, because the S&L model had a vulnerability that would prove catastrophic. It was built for a world where interest rates never changed very much. Consider the fundamental mismatch at the heart of every S&L. On one side of the balance sheet, they held 30-year mortgages, loans that wouldn't be repaid in decades, locked in at fixed interest rates of 6, 7, maybe 8%. On the other side, they held deposits that could be withdrawn at any time. As long as interest rates stayed relatively stable, this worked fine. The S&L paid 3% to depositors, earned 6% on mortgages, and the difference covered operating costs and provided a modest profit. But what happens when interest rates rise dramatically? The S&L is trapped. They're still earning 6% on all those old mortgages they made years ago, but now they have to pay 12, 13, 14% to keep depositors from moving their money to money market funds or treasury bonds. The 363 rule becomes the 614 bankruptcy rule. This wasn't a theoretical problem. Throughout the 1970s, the warning signs were everywhere. Inflation was rising, the Federal Reserve, under Chairman Paul Volcker, was preparing to raise interest rates aggressively to fight that inflation, and S&L executives were starting to realize they were sitting on a time bomb. In 1979, the FHLBB, the regulatory agency overseeing S&Ls, ran internal projections of what would happen if interest rates rose significantly. The analysis was stark. Under a scenario of sustained high interest rates, as many as 80% of savings and loan institutions would become technically insolvent within 3 years. That came from an FHLBB internal memorandum, September 1979, page 4. The people running the system knew what was coming. They could see the entropy building, the slow transformation of a stable system into an unstable one. The question was what they would do about it. Part 3, the deregulation solution. Before we continue, a brief disclaimer about perspective. What follows is an account based on documented records, testimony, and institutional reports. But like any historical narrative, it reflects certain viewpoints more than others, primarily those of regulators, investigators, and institutional analysts. The perspectives of S&L executives, industry advocates, and free market proponents are represented through their documented actions and public statements, but this account is inherently limited by what made it into the official record. As with any complex financial crisis, reasonable people disagreed then and disagree now about causes, solutions, and culpability. When interest rates began their historic climb in the late 1970s, the S&L industry faced an existential threat. The solution that emerged was elegant in its logic and catastrophic in its implementation: deregulation. The reasoning seemed sound. If S&Ls were losing money because they were restricted to making low-interest home loans, why not let them invest in other, higher-yielding assets? If they couldn't compete for deposits because of interest rate caps, why not remove those caps? If the problem was that regulations made the industry too rigid to adapt to changing conditions, why not make the industry more flexible? This wasn't a conspiracy. It was a bipartisan consensus. The Depository Institutions Deregulation and Monetary Control Act of 1980, signed by President Carter, began the process of phasing out interest rate caps. The Garn-St Germain Depository Institutions Act of 1982, signed by President Reagan, went much further. It dramatically expanded what S&Ls could do with depositor money. Suddenly, S&Ls could make commercial real estate loans. They could invest in corporate bonds, including high-yielded junk bonds. They could offer adjustable-rate mortgages. State-chartered S&Ls in states like California and Texas were given even broader powers. They could invest directly in real estate developments, buy corporate stock, even fund speculative land deals. President Reagan, at the signing ceremony for Garn-St Germain, called it the most important legislation for financial institutions in 50 years. He declared, "This legislation represents a significant reduction in regulatory burdens that have constrained the industry's ability to compete and innovate." The theory was that S&Ls, now free to pursue higher-yielding investments, would earn their way out of trouble. But the theory had a fatal flaw. It assumed that S&L executives, trained for decades in the conservative art of home lending, would exercise prudent judgment when given access to new, riskier investment options. It assumed expanded powers would be used to diversify risk, not concentrate it. And it assumed that the regulatory infrastructure, already struggling to oversee a troubled industry, would somehow be able to police a vastly more complex system. None of these assumptions proved correct. The entropy accelerated. What had been a slow-moving crisis of interest rate mismatch became a fast-moving crisis of moral hazard and fraud. Because deregulation came with a critical detail that changed everything. Deposit insurance limits were raised from $40,000 to $100,000 per account. Your deposits were still guaranteed by the federal government, even as the institutions holding those deposits were free to take unprecedented risks. Think about the incentive structure this created. If you were running a struggling S&L, already technically insolvent because your old mortgage portfolio was worth less than your deposits, you now had a perverse incentive to bet big. If your risky investments paid off, you could save the institution and become a hero. If they failed, the federal government would cover the depositor losses. Heads you win, tails the taxpayer loses. This is what economists call moral hazard, and it became the defining feature of the S&L crisis. Institutions that were gambling for resurrection became the norm, not the exception. Part 4. The Cowboys and the Frauds. If you're finding this analysis of market disorder valuable, subscribe to Financial Entropy for more investigative deep dives into the systemic patterns that reshaped financial history. The story of how S&Ls transformed from conservative home lenders into high-risk casinos can be told through individual institutions. Each one followed a slightly different path into chaos, but the patterns are unmistakable. Consider Lincoln Savings and Loan of Irvine, California. In 1984, it was acquired by Charles Keating, a Phoenix real estate developer with political connections and grand ambitions. Under the old rules, Keating could never have owned an S&L. He had no banking experience and a history of securities violations. Under the new rules, he was exactly the kind of entrepreneur that deregulation advocates believed would revitalize the industry. Keating transformed Lincoln from a traditional home lender into a vehicle for his development projects. He invested depositors' funds into speculative Arizona land deals. He bought junk bonds from Michael Milken's operation at Drexel Burnham Lambert. He furnished the S&L's offices with European antiques and original art. Lincoln Savings spent $14,000 per employee on lavish office furnishings, compared to an industry average of $1,500. Source, General Accounting Report, 1989, page 28. But the real innovation was how Lincoln attracted deposits. Keating's employees would target elderly customers in Lincoln's branches, particularly in California, and persuade them to move their federally insured CDs into uninsured junk bonds issued by Lincoln's parent company. The sales pitch emphasized that both products were sold at Lincoln, implying they were equally safe. They weren't. Source, approximately 23,000 bondholders lost an estimated $250 million when Lincoln Savings collapsed. House Banking Committee, Report on Lincoln Savings Investigation, 1990, page 67. When federal regulators in San Francisco tried to examine Lincoln's books and restrict its activities, Keating fought back with everything he had. He hired former regulators as consultants. He retained accounting firms to produce favorable audits. He mobilized 5 U.S. senators, later known as the Keating Five, to pressure regulators to back off. At one meeting, Keating's representatives asked the lead regulator if he had any questions. The regulator responded, "Yes, why are you here?" The answer was clear: political protection through campaign contributions. Lincoln Savings eventually failed in 1989, costing taxpayers $3.4 billion. But Lincoln was just one example in a landscape of dysfunction. In Texas, the deregulation story took an even more dramatic turn. State regulators there, swept up in the deregulatory fervor, gave Texas S&Ls virtually unlimited freedom. They could invest 100% of their assets in speculative ventures. The predictable result was an explosion of risky lending. Vernon Savings and Loan, based in Dallas, became a cautionary tale of what happens when oversight disappears entirely. Under new ownership in the mid-1980s, Vernon transformed into a funding machine for luxury developments, casinos, and condominiums that had no realistic chance of succeeding. Its executives maintained vacation homes in California that were ostensibly for business use, but functioned as personal retreats. Source: Vernon Savings officers diverted approximately $60 million in institution funds for personal use. FBI Investigation Report, 1987, page 11. The mathematics of Vernon's collapse were staggering. When federal regulators finally seized it in 1987, they discovered that Vernon had $1.3 billion in assets and $1.6 billion in liabilities. It was $300 million in the hole. But the true losses were much larger when considering the cost of making depositors whole and selling off bad loans at deep discounts. Source: the estimated cost to taxpayers of resolving Vernon Savings exceeded $1.4 billion. Resolution Trust Corporation Case Analysis, 1991, page 3. But perhaps no institution better exemplified the crisis than Silverado Banking, Savings and Loan Association, in Denver, Colorado. Silverado's story involves real estate speculation, political connections, and a board member named Neil Bush, the son of Vice President George H.W. Bush. Silverado made hundreds of millions of dollars in loans to developers who were simultaneously paying Neil Bush consulting fees. The conflicts of interest were blatant. Developers would receive loans from Silverado, then pay Bush, who sat on the board that approved those loans. Bush failed to disclose these relationships adequately. When Silverado collapsed in 1988, just before George H.W. Bush was elected, it cost taxpayers $1.3 billion. Source: Neil Bush's failure to disclose business relationships with Silverado borrowers represented a conflict of interest that violated OTS Administrative Order, 1991, page 9. The individual frauds were stunning, but the larger story is about systemic failure. Thousands of S&Ls were making similar decisions, taking similar risks, and justifying it with similar logic. They weren't all criminals. Many were simply responding rationally to the incentives the system had created, and the regulators who were supposed to stop them were overwhelmed, underfunded, and in many cases, captured by the industry they oversaw. Part 5. The Regulatory Collapse. The story of S&L regulation in the 1980s is the story of a system eating itself from within. The Federal Home Loan Bank Board, the primary regulator of S&Ls, was always an odd institution. Unlike the Federal Deposit Insurance Corporation or the Comptroller of the Currency, the FHLBB had a dual mission. It was supposed to both regulate the S&L industry and promote its growth. This was like asking the fire department to also sell fire insurance. The incentives were fundamentally misaligned. When the crisis accelerated in the mid-1980s, the FHLBB was led by Edwin Gray, a Reagan appointee and former S&L executive himself. Gray had initially supported deregulation, but by 1984, he'd seen enough to become alarmed. He began pushing for tighter oversight, limits on risky lending, and more aggressive enforcement. The response from the industry and its political allies was swift and brutal. Gray was attacked as a regulator who didn't understand the modern financial system. S&L trade associations lobbied Congress to cut the FHLBB's budget. When Gray tried to hire more examiners to inspect troubled institutions, he was blocked. The FHLBB's examination staff actually declined during the period when S&L risk-taking was exploding. And there was another problem: regulatory forbearance. This was the policy, implemented to avoid widespread failures, of allowing insolvent S&Ls to continue operating rather than shutting them down immediately. The theory was that if given time, many S&Ls would be able to earn their way back to solvency as interest rates eventually fell. But forbearance had the opposite effect. It allowed zombie institutions, already insolvent, to continue taking deposits and making loans. And because these institutions had nothing to lose, they took even greater risks. They were already dead. They were just being allowed to keep moving. Quote, "The policy of regulatory forbearance, by allowing insolvent institutions to continue operations, significantly increased the ultimate cost of the crisis." End quote. Source: National Commission on Financial Institution Reform, Recovery, and Enforcement, 1993, page 87. By 1987, the Government Accountability Office estimated that the FSLIC, the insurance fund that protected S&L deposits, was itself insolvent. The fund had been depleted by years of failures and now faced potential liabilities that exceeded its resources by billions. The federal government was implicitly guaranteeing deposits at thousands of S&Ls, but the insurance fund meant to cover those deposits had run out of money. This created a political problem. Acknowledging the full scope of the crisis would require a massive taxpayer bailout, tens of billions of dollars at a minimum. No politician wanted to propose that, especially in an election year, so the crisis was allowed to metastasize. Insolvent S&Ls stayed open, losses mounted, and the bill that would eventually come due grew larger with each passing month. Part 6. The Reckoning. The full scale of the S&L crisis became undeniable after the 1988 presidential election. In 1989, the newly inaugurated President George H.W. Bush acknowledged what could no longer be hidden. The S&L industry was broken, the insurance fund was bankrupt, and taxpayers would have to pay to clean up the mess. The Financial Institutions Reform, Recovery, and Enforcement Act of 1989, FREA, represented a complete reversal of the deregulatory philosophy that had dominated the previous decade. It abolished the Federal Home Loan Bank Board and replaced it with the Office of Thrift Supervision. It massively increased the capital requirements for S&Ls, it restricted the types of investments they could make, and, most importantly, it created the Resolution Trust Corporation, a new government agency whose sole purpose was to take over failed S&Ls, sell off their assets, and make depositors whole. The RTC became the largest liquidator of assets in American history. Between 1989 and 1995, it seized and sold off more than 700 failed S&Ls. The inventory was staggering, hundreds of billions of dollars in real estate, mortgages, land, office buildings, strip malls, half-finished subdivisions. The RTC's auctions became a fixture of American business news. Investors could buy entire loan portfolios for pennies on the dollar. Some people made fortunes during this liquidation. Investors who had capital during the early 1990s recession could acquire real estate and loan portfolios at massive discounts. The crisis, like all financial crises, represented a transfer of wealth from the many to the few who were positioned to take advantage of it. But the human cost was measured differently. Thousands of families who had deposited money in S&Ls that sold them uninsured bonds lost their life savings. Retirees who had been told their investments were safe discovered they weren't covered by federal insurance. Workers at failed S&Ls lost their jobs. Communities built around speculative real estate developments found themselves with empty office parks and abandoned construction sites. The final accounting was brutal. The total cost to taxpayers of resolving the S&L crisis was approximately $132 billion in direct costs, equivalent to more than $280 billion in today's dollars. This included the cost of making depositors whole, paying off the bonds issued to finance the cleanup, and covering the operational expenses of the RTC. The total direct cost to taxpayers of resolving the S&L crisis reached $131.8 billion. Source: FDIC Banking Review 2000, page 31. But the total economic cost was much larger. That figure doesn't include the lost economic value from bad loans that were never repaid, the development projects that collapse, the businesses that failed when S&L credit dried up, or the broader economic impact of a financial crisis that contributed to the recession of the early 1990s. More than 1,000 people were prosecuted for S&L-related crimes. Charles Keating was convicted of fraud and served more than 4 years in prison before his conviction was overturned on a technical ground. Dozens of other S&L executives were sentenced to prison terms, but many walked away wealthy, having extracted millions in compensation before their institutions collapsed. Part 7. The Pattern and the Warning. At Financial Entropy, we analyze historical patterns to understand modern risks. The S&L crisis offers lessons that resonate decades later. The first lesson is about the architecture of stability. The original S&L system worked precisely because it was constrained. The regulations that industry advocates saw as stifling were actually the structural supports that kept the system upright. When those supports were removed, when S&Ls were given the freedom to take new risks without corresponding increases in oversight, the predictable result was collapse. This is entropy in its purest form, the transition from order to disorder. The S&L system of the 1960s was highly ordered, simple, constrained, predictable. The deregulated S&L system of the 1980s was disordered, complex, unconstrained, unpredictable. And in financial systems, disorder is expensive. The second lesson is about moral hazard. When you combine limited downside risk with unlimited upside potential, when you tell institutions they can gamble with government-insured money, you shouldn't be surprised when they gamble recklessly. The deposit insurance system was meant to prevent bank runs and protect depositors, but when combined with deregulation, it became an invitation to speculation. The S&L crisis demonstrated that you can't deregulate just part of a financial system. You can't give institutions new powers while maintaining old protections. The system needs to be internally consistent. Either you have extensive regulation and government guarantees, or you have minimal regulation and market discipline. The 1980s S&Ls had neither. They had the freedom to take risks and the guarantee that taxpayers would cover the losses. The third lesson is about regulatory capture. The S&L industry had enormous political influence. It employed former regulators, it made campaign contributions, it funded think tanks and advocacy organizations that pushed deregulatory policies. When regulators like Edwin Gray tried to crack down, they were overruled, defunded, and sidelined. The industry successfully delayed the day of reckoning by years, but every year of delay made the ultimate cost larger. The fourth lesson is about systemic versus individual failure. Yes, there were criminals like Charles Keating who committed fraud. Yes, there were incompetent executives who made disastrous decisions. But the crisis wasn't primarily about individual bad actors. It was about a system designed to encourage risk-taking and discourage oversight. Most S&L executives weren't criminal mind masters. They were ordinary people responding to the incentives they faced. And the final lesson is the illusion of safety. For decades, Americans believed S&Ls were safe because they were boring, local, and insured by the government. That belief was largely correct until it suddenly wasn't. The system worked until it didn't. And when it failed, the failure was spectacular. This pattern repeats throughout financial history. Institutions described as safe often are safe, right up until the moment they become dangerous. The transition can be gradual and invisible until it becomes sudden and obvious. Understanding this pattern doesn't make you a pessimist, it makes you a realist. Part 8. The Modern Echo. The S&L crisis isn't ancient history. Its echoes are everywhere in modern finance. Consider the 2008 financial crisis. The parallels are striking. Financial institutions taking excessive risks with complex instruments, regulatory agencies captured by the industries they oversaw, political pressure to delay intervention, and ultimately, a massive taxpayer bailout. The specific mechanisms were different, subprime mortgages and derivatives instead of junk bonds and land speculation, but the underlying dynamics were remarkably similar. Or consider the current debate over cryptocurrency regulation. The arguments sound familiar. Innovation requires freedom from regulation. Traditional rules don't apply to new technologies. The market will discipline bad actors without government intervention. These were the same arguments made for S&L deregulation in 1982. The cryptocurrency industry even has its own version of deposit insurance, exchange protections and guarantees that have failed repeatedly when exchanges collapse. The S&L crisis also explains something about American economic policy. The bailout cost was so enormous that it constrained federal spending on other priorities for years. The experience made politicians and regulators extremely wary of financial deregulation throughout the 1990s. But by the 2000s, those lessons had faded. A new generation of policymakers, convinced that this time is different, began removing restrictions on financial institutions again. The 2008 crisis was the result. There's a larger pattern here about institutional memory. Financial crises teach hard lessons, but those lessons are learned by specific people at specific times. As those people retire and new leaders emerge, the lessons fade. The incentives to take risk, to cut regulatory corners, to believe that new conditions make old rules obsolete, those incentives are permanent. The memory of what happens when you give in to those incentives is temporary. For investors and savers in 2024, the S&L crisis offers practical wisdom. First, safe is a context-dependent term. An institution is only as safe as its balance sheet, its oversight, and the systemic environment it operates in. S&Ls were safe in 1970 and catastrophically risky in 1985. The institutions hadn't fundamentally changed, but the system around them had. Second, government guarantees are only as good as the government's ability and willingness to honor them. The FSLIC guaranteed S&L deposits, but when the fund went bankrupt, there was a real possibility that depositors might not get their money back. Only a political decision to have taxpayers cover the shortfall made depositors whole. That decision isn't automatic. It's political. Third, when you see regulatory rollbacks in financial services, ask why. Sometimes deregulation makes sense, old rules become outdated, new efficiencies are possible. But often, deregulation is driven by industry lobbying, not by genuine policy innovation. And the cost of getting it wrong is enormous. The S&L crisis demonstrated that financial entropy, the decay of stable systems into unstable ones, follows predictable patterns. It starts with constraints being removed, it accelerates with moral hazard, it culminates in a crisis, and it ends with taxpayer bailouts and calls for re-regulation. This pattern has played out repeatedly, from the S&L crisis to the 2008 financial meltdown to the regional bank failures of 2023. Understanding this pattern doesn't mean you can predict the next crisis with certainty. Financial systems are too complex for that. But it does mean you can recognize the warning signs when stability is giving way to disorder, when institutions that are supposed to be safe start taking unusual risks, when regulators are defunded or sidelined, when political leaders promise that deregulation will unleash growth without acknowledging the risks, when guarantees are extended without corresponding oversight. These are the signs of entropy building in the system. And in finance, entropy is expensive. As we close this investigation, it's worth considering what the S&L crisis reveals about the nature of financial systems and the societies that depend on them. The standard narrative of the crisis is that it was a failure of deregulation, that removing constraints from S&Ls created opportunities for risk and fraud that predictably led to collapse. This narrative is largely correct, but it's incomplete. because the original S&L model was already failing before deregulation. The interest rate mismatch, the fundamental vulnerability of borrowing short and lending long at fixed rates, was exposing S&Ls to enormous losses by 1980. Something had to change. Doing nothing wasn't a viable option. The question is whether there was a path between the Scylla of rigid regulation that couldn't adapt to changing conditions and the Charybdis of wholesale deregulation that invited disaster. Could S&Ls have been given more flexibility without removing oversight? Could deposit insurance have been reformed to reduce moral hazard? Could regulators have been given more resources instead of fewer? Perhaps. But these hypotheticals miss a deeper point about financial systems. They exist in political environments, and those environments constrain what's possible. In the late 1970s and early 1980s, the political consensus favored deregulation, smaller government, and trusting market forces. That consensus shaped the policy options that were considered feasible. The idea of strengthening regulation while simultaneously making it more flexible, the kind of nuanced approach that might have worked, wasn't politically viable. This raises uncomfortable questions about democratic governance of complex financial systems. The optimal policies required technical expertise and long-term thinking, but the political process rewarded simple messages and short-term benefits. The S&L industry lobbied for deregulation and was politically powerful enough to get it. The diffuse harm, to taxpayers, to the broader economy, wasn't represented as effectively in the political process. And there's a question about class and fairness. The S&L crisis was largely paid for by middle-class taxpayers. The benefits during the bubble years, the high interest rates offered by desperate S&Ls, the development projects, the paper wealth created by inflated real estate values, accrued to a much narrower group. And the investors who bought distressed assets at the bottom made fortunes, while ordinary families were struggling through recession. This pattern of socialized losses and privatized gains became a defining feature of American capitalism in the decades after the S&L crisis. It appeared again in the 2008 bailouts, in the rescue of major corporations during the pandemic, and in countless smaller interventions. The S&L crisis established the precedent that when financial institutions fail catastrophically, taxpayers will cover the cost. Is there an alternative? In theory, yes. You could let institutions fail and depositors lose money, which would create market discipline, but potentially trigger bank runs and financial panics. You could have much stricter regulation that prevents institutions from failing in the first place, but at the cost of efficiency and innovation. Or you could try to design systems where the people who benefit from financial risk-taking are the same people who bear the costs when those risks go bad. But theory collides with reality. When a crisis hits, the political pressure to prevent immediate catastrophe overwhelms concerns about long-term moral hazard. And so, the pattern continues. Part 10. The entropy accelerates. As we conclude, it's worth stepping back to see the S&L crisis in the context of long-term economic history. The crisis wasn't an isolated event. It was part of a larger transformation of the American financial system that began in the 1970s and continues today. For most of the post-World War II period, American finance was stable, constrained, and frankly, a bit boring. Banks made loans to businesses and consumers. Investments were straightforward. Financial crises were rare. This stability was built on the regulatory architecture created during the Great Depression. The Glass-Steagall Act separating commercial and investment banking, strict capital requirements, limited geographic scope for banks, restrictions on what financial institutions could do. This system had costs. It was inefficient in some ways. It limited financial innovation. It protected incumbent institutions from competition. But it was stable. The entropy was low. The S&L crisis was the first major crack in the system. It demonstrated that deregulation without adequate oversight could lead to disaster. But instead of learning the lesson that stability requires structure, policymakers and industry advocates drew a different lesson. The crisis happened because deregulation didn't go far enough. Throughout the 1990s and 2000s, the financial deregulation that began with S&Ls continued and accelerated. Glass-Steagall was repealed in 1999. Banks were allowed to grow larger and more complex. Derivatives markets expanded with minimal oversight. The shadow banking system, institutions that functioned like banks but weren't regulated as banks, grew to rival the traditional banking sector. The entropy accelerated. Financial systems became more complex, more interconnected, more opaque. Innovation was celebrated. Risk management became more sophisticated in some ways, but also more divorced from underlying reality. Models replaced judgment, and the warnings from those who remembered 1989 or 1929 were dismissed as outdated thinking. The 2008 crisis was the next major crack. It was an order of magnitude larger than the S&L crisis. The bailouts cost more, the economic damage was greater, the global impact more severe. But again, the fundamental lessons about financial entropy weren't learned. After initial reforms, the political and industry pressure resumed to roll back regulations, to allow institutions to grow larger, to enable new forms of risk-taking. And so we arrive at the present day. The financial system is more complex, more globally interconnected, and more dependent on government guarantees than at any point in history. The entropy is higher, the potential for instability is greater, and the political will to impose the kind of structural constraints that might reduce that entropy is weak. The S&L crisis demonstrated something that should be obvious, but is constantly forgotten. Financial systems don't spontaneously organize into stable configurations. Stability is a product of structure, oversight, and constraint. When those are removed, disorder naturally increases. That's entropy, not as a metaphor, but as a reality of how these systems behave. For you, our viewer, the practical lesson is simple but profound. In financial systems, safety is always provisional. The institutions and structures that appear solid today may be fragile tomorrow. The guarantees that seem absolute may prove contingent, and the warnings that seem alarmist may turn out to be prescient. This isn't a counsel of despair. It's an argument for attention. Understanding how financial systems decay, how boring neighborhood savings and loans became casinos, how guarantees became invitations to gamble, how regulators became cheerleaders, gives you a framework for evaluating risk in your own financial life. When you hear politicians or industry advocates arguing for deregulation in financial services, you should ask, what structural protections are being removed? What new risks are being created? Who benefits if this works, and who pays if it fails? These are the questions that weren't asked loudly enough in 1982. When you hear that an institution or investment is safe, you should ask, safe under what conditions? Safe based on what assumptions? Safe according to whose analysis? The people who deposited money in Lincoln Savings or Vernon S&L thought their money was safe. The insurance was supposed to guarantee it. The regulators were supposed to watch over it. But systemic failure overrode all of those protections. Part 11. The Final Accounting. The total cost of the S&L crisis, $132 billion in direct taxpayer expense, is a number too large to fully comprehend. But we can try. In inflation-adjusted terms, that's equivalent to more than $280 billion today. It's more than the annual budget of most federal departments. It's enough to build hundreds of hospitals, thousands of schools, or fund decades of scientific research. Instead, it went to make whole the depositors of failed S&Ls and to cover the losses from bad loans that should never have been made. But the true cost extends beyond dollars. There's the opportunity cost, what that money could have funded instead. There's the economic cost of the early 1990s recession that the crisis contributed to. There's the cost to faith in financial institutions and government oversight. And there's the cost in precedent. The S&L bailout established that when financial institutions fail catastrophically, taxpayers will cover the losses. This precedent shaped expectations during the 2008 crisis, when banks, investment firms, and auto companies were bailed out at taxpayer expense. It shapes expectations today when regional banks fail and regulators immediately step in to guarantee deposits beyond the statutory limits. The S&L crisis also revealed something about American political economy, that the costs of financial failure can be socialized while the benefits of financial success remain private. The people who made fortunes during the S&L boom, the executives who extracted high salaries, the developers who got sweetheart loans, the investors who bought junk bonds at high yields, largely kept their gains. The losses were borne by a much broader population. This asymmetry is corrosive to democratic legitimacy. It creates a sense that the system is rigged, that there are different rules for different people, that the wealthy and connected can gamble with other people's money and face limited consequences when those bets go bad. These perceptions aren't entirely accurate. Many S&L executives did face consequences, and many wealthy people lost money in the crisis. But they're accurate enough to shape political attitudes and erode trust in institutions. The challenge for policymakers is that the alternatives to bailouts are also costly. Letting financial institutions fail can trigger broader panics, bank runs, and economic collapse. The Great Depression demonstrated what happens when governments don't intervene in financial crises. The lesson drawn from that experience, that government must act as a backstop to the financial system, is largely correct. But this creates a trap. If financial institutions know they'll be bailed out, they have incentives to take excessive risks. But if they're not bailed out, the costs of failure fall on innocent bystanders, depositors, borrowers, workers, communities. The S&L crisis showed both sides of this trap. The bailout was expensive and created moral hazard, but the alternative, allowing hundreds of S&Ls to fail without government intervention, would likely have been even more catastrophic. Breaking out of this trap requires getting ahead of crises rather than reacting to them. It requires the kind of structural regulation that prevents institutions from becoming too risky in the first place. It requires oversight that catches problems early before they become catastrophic. And it requires political will to constrain powerful industries, even when times are good and crises seem distant. This is what didn't happen before the S&L crisis. The warnings were there. The Federal Home Loan Bank Board knew in 1979 that rising interest rates would devastate the industry. But the political will to address the problem proactively, whether through recapitalization, restructuring, or orderly closure of insolvent institutions, didn't exist. Instead, the crisis was allowed to build until it became too large to ignore and too expensive to resolve cheaply. This pattern repeated before 2008, when regulators and policymakers ignored warnings about subprime lending and derivative risks. And it's repeating now as new risks accumulate in various parts of the financial system while political attention focuses elsewhere. The S&L crisis teaches that financial entropy is an ongoing process, not a one-time event. Systems don't fail and then rebuild themselves better than before. They fail, get patched up, and then slowly begin accumulating new vulnerabilities. The regulations created after the S&L crisis didn't prevent the 2008 crisis. The regulations created after 2008 won't prevent the next one, because the fundamental dynamic, the tension between stability and innovation, between constraint and freedom, between regulation and capture, never resolves permanently. Part 12. Living with Entropy. We began with a father and daughter walking into a savings and loan in 1979, depositing birthday money into a college fund. Let's return to them in 1989. The building is different now. It's been taken over by federal regulators, rebranded, and eventually sold to a larger bank. The tellers are different. The friendly, small-town atmosphere is gone, replaced by the efficient impersonality of a national chain. But the deposits are safe. The federal government made sure of that, at taxpayer expense. The daughter is in college now. The money that was supposed to help pay for it is there, plus interest. But the father, who worked in commercial real estate, lost his job when the local development market collapsed under the weight of bad S&L loans. The family home, purchased with an S&L mortgage, is worth less than they paid for it. The economic ripples from the crisis have touched them in ways they don't fully understand. This is the human scale of financial entropy, the quiet ways that systemic failure reshapes individual lives. The story isn't dramatic. There's no moment of crisis for this particular family, no telegram announcing loss, no sudden catastrophe. Just a slow degradation of circumstances, a sense that the future is less secure than it once seemed, a vague awareness that something important has been lost. Multiply this by millions of families, and you have the social cost of the S&L crisis, not just the $132 billion in direct taxpayer expense, but the broader economic damage, the lost opportunities, the eroded trust, the sense that institutions meant to serve communities had instead exploited them. At Financial Entropy, we investigate these patterns because understanding them provides a framework for navigating an inherently unstable financial landscape. The core insight is simple. Financial systems are always in flux, moving between states of greater and lesser order, and that movement has real consequences for real people. The S&L crisis wasn't the first financial crisis in American history, and it won't be the last. The specifics change, the institutions, the instruments, the regulatory frameworks, but the patterns recur. Periods of stability create complacency. Complacency creates pressure to remove constraints. Removing constraints enables risk-taking. Risk-taking eventually leads to crisis. Crisis leads to new regulations, and the cycle begins again. You can't escape this cycle. It's built into the nature of financial systems and the human behavior that drives them. But you can position yourself to weather it. That means maintaining appropriate skepticism about claims that this time is different. It means understanding that institutions described as safe may be safe only under certain conditions, and that those conditions can change. It means recognizing that government guarantees are political decisions, not natural laws, and that they can fail or be revoked. Most importantly, it means understanding that financial disorder, entropy, is the natural state, and that order must be constantly maintained through structure, oversight, and constraint. When you see those structures being dismantled, when you see oversight being weakened, when you see constraints being lifted, you should recognize these as warning signs that entropy is increasing and that the system is becoming less stable. The S&L crisis demonstrated the cost of ignoring those warning signs. From 1979 to 1989, the American financial system transformed from one of the most stable in the world to one experiencing the largest financial crisis since the Great Depression. The cost was measured in hundreds of billions of dollars, countless lost jobs, failed businesses, and the erosion of trust in financial institutions and government oversight. The lesson isn't that we should return to the regulated financial system of 1960. That world is gone, superseded by technological change, globalization, and evolved financial instruments. But the lesson is that stability doesn't happen by accident. It's a product of deliberate choices about how to structure financial systems, how to balance risk and safety, and how to ensure that the people who benefit from financial risk-taking are the ones who bear the costs when those risks go bad. As we close this investigation, the question isn't whether another financial crisis will occur, it's when, and whether we'll have learned enough from past crises to reduce the damage. The S&L crisis cost $132 billion. The 2008 crisis cost trillions. The next one could cost even more, unless we apply the lessons that history keeps teaching us. But applying those lessons requires political will, regulatory capacity, and public attention. It requires resisting the constant pressure from industry to relax oversight, to let institutions grow more complex, to trust that this time really is different. And it requires remembering, even decades later, what happens when financial entropy goes unchecked. That's the purpose of financial entropy, to keep the record alive, to document the patterns, and to provide you with a framework to understand financial disorder when you see it building in real time. The S&L crisis is history, but the dynamics that caused it are present tense. The entropy continues, and understanding it remains the best protection against being surprised when order gives way to chaos once again. The father and daughter from our story eventually recovered. The father found new work, the daughter graduated, life continued as it does, but they never again looked at their bank the same way. They'd learned, at considerable cost, that safety is provisional, and that lesson, painful as it was, made them better prepared for the financial instability that would come later in their lives. That's what history offers us. Not certainty, not protection, but preparation. The entropy continues, but now you understand it. And in financial systems, understanding is the beginning of wisdom. If you found this analysis valuable and want to track the patterns of financial disorder with us, hit the bell icon to subscribe to Financial Entropy, because the decay never stops, but neither do we. This has been Financial Entropy. Thank you for investigating the past to understand the present.